Welcome to Acres Financial Group and Winning in Retirement radio show's classroom session. Today's class is on required minimum distributions and qualified charitable distributions. These affect people 70 and a half and 72, but we'll give a lot of detail. We actually have Jeff Akers, certified financial planner and practitioner from Acres Financial Group. I've been working alongside my cousin Jeff for 21 years. He'll be our speaker today. But before we have him come on, there's a few things you need to know about today. If you have any questions as we go through, you can go to our chat box and talk with one of the advisors who are listening in with you during the live session here in May. Coming up at the end of this week, beginning of next week, May 17th will be the actual federal filing date. Make sure you don't miss that on your taxes. Don't put off anymore. Make sure you get things in. All right, for those first-time people who have never listened to our webinar before, you are eligible for our lovely blanket, the Acres Financial Comfortable Blanket. Very, very nice. Hopefully you can sign up for that, and we'll get it out to you as soon as we can. We do thank you for listening to our talks. I'm sorry that we cannot have these expos or seminars together yet. We're looking forward to planning something in the fall of 21 to be in person. Right now, we're still working towards that future. These webinars we're doing every 2 weeks. Today is May 13th. We're going to be doing our next one in 2 weeks, May 27th. And that'll be real close to the May 29th day, which is 529 day, which is 529 plans. That's got to be the topic. That topic that's Saturday morning on May 29th at 11 a.m. on 105.7 The Fan. What we're going to have that day will be a 529 college savings plan talk. So we'll have that as our webinar on the 27th and as our radio show on May 29th. Our website, acresfinancial.com, can give you a lot of information about our company, about everyone that works at Acres Financial Group. Also give you information about the webinars and radio shows. You can listen to these again and again and again. Even the radio shows are available through podcasts. So there's a lot going on today. Jeff's done a great job of putting together this little talk for you on the basics of RMD and QCDs. Let's go to Jeff.
Hi there, and thank you for joining me for another classroom session from Winning in Retirement. My name is Jeff Akers, and today I'm going to be talking with you about required minimum distributions as well as qualified charitable distributions, RMDs and QCDs. Now, as we go through this information, there will be a lot of numbers, and I'll show you how calculations are done and things like that. Don't let the numbers get in the way. I'm hoping that you'll understand the concepts that we're trying to get across here today. If you understand the concept behind the required minimum distribution and the qualified charitable distribution, then you can use these things to develop a good plan for how to take care of them as you go through retirement. So I'm going to begin by sharing my screen so you can see what's going on here. And you can see, here that we're talking about RMDs and QCDs. There we go. Finally got my pointer working. I need to go into our disclosures. One thing that I want to point out here is that our broker-dealer is Kalos Capital, and our investment advisory services are offered through Kalos Management. These are located in Alpharetta, Georgia. That's where their address is. And they provide kind of oversight for us and review things and stuff like that for us. The rest of these disclosures are important as well. We put this information together. Things are changing quickly. And so as of the date that we did this, we did our best to get the most current information we could use, but just keep in mind, Congress can pass a new law at any time. This also is not intended to be specific advice. This is merely going through the concepts for you. We can apply that in specific advice for you, but that would come in a one-on-one meeting type situation. All right, so moving on, the ins and outs of RMDs and QCDs. It says at 72, it's time to start taking retirement withdrawals. And you might wonder, why 72? Well, there was a change that was passed in 2019, took effect in 2020. the required minimum distribution age used to be 70 and a half, and it was changed to age 72. So if you heard 70 and a half and thought there was something going on with that, yes, there used to be, but now that is age 72. So the IRS requires that you begin taking money annually out of your IRAs, also employer-sponsored plans. I know here it mentions specifically 403Bs, but that does also apply to 401Ks, TSPs, other employer-sponsored plans. I see the question, why do I have to take a withdrawal? And I kind of sum it up this way. When you put money into that employer-sponsored plan, the 401K, the 403B, the TSP, or into a regular IRA, and you are able to take the tax deduction, a deductible contribution. Well, you got that deduction for the money going into the IRA, 401K, or what have you. You didn't pay tax on that money. While it's inside the IRA or the employer-sponsored plan, it's tax deferred. So any growth, you're not paying tax on that either. There is no tax on the money in that plan until you take it out. So at 72, that's where the Congress has determined that you have to start taking money out so that you pay tax on that money. So it has more to do with taxes than necessarily retirees needing income. It has more to do with Congress not wanting money to stay in a plan that never gets taxed. So let's talk about how much you're going to have to take out. There is a calculation that's done, and we'll get into the calculation in a minute. But I want to point out that if you have multiple IRAs, let's say you have 3 IRAs, we have to calculate what your required minimum distribution is from each of those 3 IRAs. After we've added that up, we've calculated all 3, we add them up, we can take that full amount from any one of those 3 IRAs. So we could take it from 1, we could take it from 2, or we could split it up among all 3. But the IRAs sort of count as one when it comes to calculating and taking that required minimum distribution. Now, when we get to employer-sponsored plans, 403Bs, 401Ks, IRAs, there's a wall between IRAs and the employer-sponsored plans. So if you have money in an employer-sponsored plan, you must take the required distribution from that employer-sponsored plan. 403Bs are an exception to some extent. You can do with them kind of what you do with IRAs, add them up and just take it all from one. But 401Ks, if you have 2 of those, then you have to take an RMD from each of those 2. We can't just aggregate that and take one big RMD. And you can never take an RMD for your employer-sponsored plan from your IRA. And the opposite is true as well. You can never take your RMD for your IRAs out of your 401Ks or TSP or whatever other employer-sponsored plan. So just remember, there is a wall between individual retirement accounts, IRAs, and employer-sponsored plans. Exceptions to the RMD. The first one, I don't know that it's necessarily an exception, but the first year that you're required to take a distribution from your IRA, you actually have until April 1st of the next year. So if I had to take an RMD from my IRAs for this year, this is my first year, then I actually have until April 1st of next year to take it. Now thereafter, you have to take the RMD by December 31st of the year in which it's required. So if you delay for that first year and you take one in January, February, or March of next year, you then have to take another RMD for that year. So you end up taking 2 RMDs in 1 year. And from a tax standpoint, that could be a bad thing because it can really bump up your income. We'll take a look at how that works a little bit later on. Now, another exception is if you have an employer-sponsored plan, and if the plan allows for it, and you're still working for that company where you have that employer-sponsored plan, you may be able to delay taking your RMDs until you retire. So if you're still working past age 72 and you have a 401k or something, you might be able to not have to take a distribution until you actually retire from that. Now, why is it important to take your RMD? Well, this down here kind of sums it up. The penalty for not taking your required distribution is one of the stiffest penalties that there is in the tax code. It's 50% of what you were supposed to take. So let's just say you were supposed to take $10,000 for this year and you forget to do it. You don't do it. The IRS catches you. Now you have to take out that $10,000. The first $5,000 goes to the IRS as a penalty. And then you pay regular tax, federal and state, on the entire $10,000. So as you can imagine, that's a pretty sizable chunk that comes out just for taxes. And out of that $10,000, you might end up with $2,000 or something like that. So we want to make sure that we take our RMDs when they're required. We don't want to miss one because the penalty is so stiff. Now, ways to take your withdrawal. Now, this information is from American Fund. You see American Funds on some of this. That's one of the custodians that we use for IRAs and the like. There are other custodians, but this one just mentions specifically American Funds, but it applies generally to other companies as well. You can set up an automatic plan where you tell your custodian, I want you to calculate my RMD and I want you to send it to me every year on this date. And they'll do that. They'll just automatically do your RMD for you. If you only have one IRA, that can make a lot of sense because that way you know that you're going to get it. You don't have to worry about it every year. You're going to get a check or a direct deposit into your bank account every year automatically. Or you can just take a one-time distribution. And that's a matter of filling out a form. Sometimes it's calling a company and asking them to send it. Generally, we'll stick with filling out a form to get that each year. But then if we do that one-time distribution, we have to remember each year that we have to do that form to get a distribution for that year. Now, how is it calculated? This is a uniform lifetime table. And I want to mention right now that when they changed the law and they increased the age from 70.5 to 72 for required distributions, they did not change the uniform lifetime table. However, it is changing next year in 2022. So the table we use this year to calculate your RMD is going to be different than the table we use next year in 2022. They're increasing life expectancies a little bit in that table, which is a good thing because that lowers the amount that you have to take out in the earlier years of having to take it. So how do we do this calculation? If we look down here at the first example, if we have someone with $500,000 in their IRA, the date that we use to figure out how much you have in your IRA is December 31st of last year. And then the age that we use over here is how old you will be on December 31st of this year. So the value is based on last year, the age is based on this year. So in this case, someone is 72 years old. They have $500,000 in their IRA. We go up here to the table at 72, the divisor is 25.6. So we divide 500,000 by 25.6, we come up with $19,531. That is this person's RMD. We talked about penalties before. Just imagine you've got a $20,000 RMD, you forget to take it, the penalty is $10,000. That's a big chunk to send in. So we want to make sure that we're getting these taken on time. The next example here is someone who's 80. Their IRA has gone up in value to $550,000, but the divisor goes down. Life expectancy is shorter at that point, 18.7. So the required distribution is $29,411. Now, this is the IRS telling you how long your life expectancy is, but don't worry, they don't ever actually tell you when to die. When you reach age 115, you still have a life expectancy of 1.9 years. And it stays at 1.9 years as long as you live. So according to the IRS, you never actually die. You always have almost 2 years to live. Now, RMDs can affect our taxes. So let's take a look at how taxes are calculated. And I'll take you through kind of a little example. Let's say that you're retired, you've been retired for a few years, you got a pension, maybe you're collecting Social Security, and your taxable income, you're married and you file jointly and your taxable income is right around $80,000. Well, right now that puts you in the 12% tax bracket. So that's the bracket that you're in for your taxes. Now you're turned 72, you have to take money out of your IRA. Let's say you had $500,000, so you've got to take that $20,000 out. Well, now your taxable income goes from $80,000 to $100,000, and you've jumped up to the 22% tax bracket over here. So it can actually move you from one bracket to another. Currently, standard deductions that we can take are relatively high. This was changed a few years ago for the current tax law. When you're over age 65, there is an additional deduction that goes on top of this. It's $1,350 if you're married, $1,700 if you're single. If husband and wife, married, both over 65, then that total additional deduction is $2,700. That comes off of here. So that gets you up to what, $27,800 is your standard deduction when you're in your 70s. Now, there's also the taxation of Social Security that we have to deal with. Social Security benefits are not 100% taxable. If your income is low enough, they don't count any of your Social Security as taxable income. If you're married and filing joint and your provisional income is less than $32,000, then none of your Social Security benefit is taxable. You're going to ask what provisional income is, and I'll get to that in just a second. But let's say that same situation that we talked about before, your income, provisional income works out to around $30,000. You don't have any tax on your Social Security. Now you've got to take a $20,000 RMD. Your provisional income just went up to $50,000. And as we move down the list, if your provisional income is more than $44,000, then up to 85% of your Social Security is now subject to tax. That's not an 85% tax on your Social Security. It's how much Social Security is subject to your regular income tax. If your provisional income falls between $32,000 and $44,000, then up to 50% of your Social Security is then taxable. This is a calculation that if you get your taxes done by an accountant or something, they automatically do this. If you're using TurboTax or something like that, the program automatically calculates how much of your Social Security is subject to tax. Provisional income, let's talk about that for just a second. Provisional income includes half of your Social Security benefit, all of your pension, IRA distribution, wages, dividends and interest, all that kind of stuff. And it also counts tax-free interest. Let's say you have some tax-free municipal bonds and you think, oh, good, I don't have to pay tax on the interest that I earn on those. And that's true, but it gets added into the calculation that determines how much of your Social Security is then taxable. So it's kind of a hidden way that there can be some tax from that. But that's provisional income. Half of your Social Security, all of your regular income, plus any tax-free interest gets added into that. So one of the things that we want to do as planners is look at ways to mitigate these taxes. You know, what are some things we can do, some strategies that we can use to make it better, make it work better for us. And that's where we're going to get into qualified charitable distributions. The next few slides are actually a handout that we have. So if you would like this handout, just let us know and we can get it to you. I know it comes out as 3 slides on here, but it's really just one sheet of paper, front and back, has all this information on it. I'm just going to cover a couple of the highlights on here. The first is for a qualified charitable distribution, it applies to IRA owners who are age 70 and a half or over. We said before that they raised the RMD age from 70 and a half to 72. But when they did that, they did not change the age at which you could do a qualified charitable distribution. So you can actually do a QCD before you have to take a required minimum distribution. Another thing to keep in mind here is that this works for IRAs only. You can't do it with an employer-sponsored plan like a 401k or a TSP. And finally, the amount that you can give to a charity is capped at $100,000 per person per year. So if you're married, you both have substantial IRAs, and you want to give a lot of money to charity, you can each give up to $100,000 to charities if you're over 70 and a half. Now, because you've done it this way, and we're not going to include this in your income, right here, number 5, it's a charitable donation from the IRA. It satisfies your required minimum distribution, which is good. We avoid that 50% penalty, but the IRA distribution is not includable in income. That means that it does not show up as taxable. It also means it does not show up in that provisional income calculation we just talked about with Social Security. We'll see how that works in just a minute. But because you're not showing it as taxable income to start with, you cannot then go to Schedule A and add it as a charitable contribution there and try to deduct it twice. You can only deduct it once, and we're doing it on the front page of the tax return instead of on Schedule A. We already covered that married couples can do $100,000 each. Let's move on down the line. Tax reporting for a qualified charitable distribution. Whenever you take a distribution from an IRA, you're going to receive a 1099-R from the custodian. I'll show you an example of one of those in a few minutes here. But that 1099-R shows how much money you took out, how much of it's taxable, and how much of it went to federal tax or state tax. It does not show how much went to a charity. So it's important when you use a QCD that you tell your tax preparer that you did it and how much went to charity. We're going to take a look at a tax return in a minute, and I'll show you how to know whether or not they've put it on there correctly. But it's important for you to let them know, because if they're looking at the 1099-R, they're not going to know that you gave to charity. You're going to have to tell them that you gave money to charity. So here's a case study, an example. So far, I've done a lot of talking about things, and I think sometimes this is where the numbers help. So this is a case study where someone has to take a required minimum distribution of $7,100. It's not a huge amount that this person has to take, but they like giving to charity, and so they want to give that money to a charity. So there's 2 ways you can do that. One, you take the distribution yourself, then you send a check to the charity, and you use Schedule A to write off your charitable deduction. So here's what happened over here. We take the $7,100 RMD. There is no QCD. Now this person was able to itemize their deductions because the $7,100 was added to other deductions that they had. $16,491 was the itemized deduction. Social Security, the amount that was taxable is $14,822. This leads to taxable income of $34,752 and total tax of $2,834. This is a single individual in this scenario. Over here, we have the same person. They want to do the same thing. They want to send the $7,100 to a charity. This time we're going to do it through the QCD, the Qualified Charitable Distribution. So in this case, we satisfied the RMD by sending it to a charity. Now we cannot deduct it on Schedule A, so the itemized deductions went down, and we have to take the standard deduction, which was $14,050. The amount of Social Security that was subject to tax goes down to $8,532. So we kind of got a double whammy out of this. We don't have to pay tax on the QCD, and now there's around $6,000 of Social Security that we're not having to pay tax on. So our taxable income actually went down to $23,511. It's around $11,000 less than it would have been if we had not used the QCD. Total tax is $1,484. That's almost a 50% savings, $1,350 in tax savings. This is just on the federal return. This helps on the state return as well. When we add that in, there would be additional savings in addition to this if you live in Maryland. If you live in Pennsylvania, they don't tax retirement income anyway there. But in Maryland in particular, this can make a pretty significant difference for you. Now, I want to show you on the tax return what this looks like. So we're using this same example and showing actual tax returns. Don't worry, we've whited things out to protect the innocent. This could be a little bit small maybe to see if you're looking on your computer, but hopefully it's coming through okay. This side over here is not using a qualified charitable distribution. So we see the taxable income from the IRA, $7,100 right here. And now we see 2 lines down, the amount of Social Security that's subject to tax. Total Social Security was $19,311. The amount subject to tax is $14,822. So it's a pretty substantial percentage of that. Over here, this is where we took the QCD. You'll see the $7,100 doesn't show up over here as an IRA distribution. There's a 0 there. We go over to the left and we see the $7,100 here. That tells the IRS, yes, I took the distribution from my IRA, but I used a QCD. If you see this QCD right here, that's your first clue that it was taken into account when your taxes were done. If you did a QCD and you don't see this here, then it was incorrect and it's going to need to be redone. If you do your taxes and you forgot to mention the QCD and it's already been sent in, you're going to have to amend your tax return so you can get that refund back. In this case, it would be another $1,350 refund that you got back. So it would be worthwhile to amend your tax returns. Let's talk about that 1099-R that gets sent to you. Again, this one's from TD Ameritrade. I told you we'd use a couple of different custodians that we work with. Before you saw American Funds, this is TD Ameritrade that we use for some IRAs. And the 1099-R is down here, and it shows the gross distribution, the taxable amount. It goes into how much was withheld, if anything was withheld. But there's no place on here that mentions that there is a qualified charitable distribution taken. So if you sent all of this money to a charity, then take the 1099-R, put a star on it like this and say QCD. Just make sure that your tax preparer knows how much you sent to charity, and then they can account for that on your taxes. So how do we go about taking these distributions? This is an IRA withdrawal form, a distribution form. Again, we're using TD Ameritrade as an example here. Each company has their own forms for this. The first page, we're just telling them who we are, how much we want to take out. The second page is kind of where the magic happens. In this section here, we're telling them that we want you to send a check, and this is a charitable donation. Now, I told you that it's not going to show up on the 1099-R, so you might be wondering, why does TD Ameritrade even ask? I think that TD Ameritrade is hoping that the IRS is going to update that 1099-R form and include a place on there to say how much went to charity. And so they're kind of preemptively getting ready for that. But some companies do not have a way to say that this is a charitable donation. TD Ameritrade does. And down below here, we fill in the name of the charity. That's who the check is going to be made payable to. We can have that check mailed directly to the charity. We fill in their address down here, or we can have the check made payable to the charity but sent to you, and then you'll send it on to the charity later on. Sometimes folks want to give money to their church, and so they're going there. So they just have the check mailed to them, and then they take it physically so that they know that their charity actually received it. Down here on the additional information line, I like to write something in there like donation from and your name, just so that the charity receiving it has some indication of who it was that sent it. Sometimes the checks don't necessarily have your name on it, or they're not sure where to look for your name because it's going to be actually sent from the custodian, in this case TD Ameritrade, instead of from you. That's a place most charities look. It's kind of that upper left-hand side of the check, but that's not going to be there. So this is a way that they can know who this donation came from. All right, so we've gone through a lot of information, required distributions, what you have to take out, and qualified charitable distributions is one strategy. If you want to give to charity anyway, give it from your IRA if you're eligible for a QCD, because it's a helpful tax tool. And as you saw in our example, it can reduce your taxes even more than you might think. When we looked at that one example, we thought, oh, her taxable income should go down by $7,100, and it really went down by around $11,000. So that's an excellent tool to have handy to use. So if you have any questions, you can give us a call in our office. You can shoot us an email. You can check our website, get to us that way. I'm going to stop sharing this now. So it's back to me. I want to thank you for joining us again today as we talked about required minimum distributions from your IRAs and other retirement plans, and then QCDs, which again, qualified charitable distributions can only come from your IRAs. We cannot use the employer-sponsored plans for those. So with that, again, my name is Jeff Akers. Thank you for being with us for another classroom session of Winning in Retirement.
That was Brian Akers back. My cousin did a great job of talking about required minimum distributions and QCDs, and he gave you one example of a QCD. These examples apply to you. A qualified charitable distribution is if you give to charity and do standard, you got to look at a QCD. If you are taking RMDs, money coming out of your IRAs, you're over 72, you got to take the money out and you give to charity, you really got to run your taxes with a QCD and without. Understanding that if you're going to give to charity and try to take a deduction on a Schedule A, why not take it out of the IRA at the top line on the tax return, reduce your overall income. You don't get the deduction, but by reducing that overall income, you might surprise yourself with some other savings. One of the biggest things we've seen is capital gains taxes being less. Second thing is if you have to drop below certain levels to get your Medicare premium cheaper. These are ways to control your income into 72 and beyond. I am an elite IRA advisor through Ed Slott and his program. And so we use a lot of that education to provide these educational events to you. The RMD is required out of IRAs and any retirement plan. Knowing how to and when to take withdrawals is extremely important. You also have to take RMDs out of inherited IRAs. There's many, many choices when it comes to inherit. When you receive an inheritance from a retirement plan or an IRA, and making sure you don't pay too much tax or pay it all in 1 year, you don't want to do such a thing. You need to have proper planning and pay the least amount of tax on your money. We love Roth IRAs. And what happens is if we can use the QCD as a way to reduce income at 70.5 and 71, we then could then convert more of your IRA to a Roth. And that Roth IRA conversion, you pay tax now and never again. A lot of complex financial planning issues can be accomplished through the proper uses of RMD and QCDs. So knowing these and how it applies to you directly is what we do at Akers Financial Group. Give us a call to be able to set up at a time to talk about your exact situation. For the tax year 2021, we're doing our Roth conversions in the fall because we want to know what this year's tax laws are going to be exactly, so we can make sure we make the best decision for each and every one of our clients. All right, as we close for today, thank you for listening and watching our talk. We hope you've learned a lot about RMDs and QCD. If you have questions, contact us at acresfinancial.com through our website or through our email, and we'll get back to you with any questions you might have. Stay tuned for our next webinar, May 27th. 4 p.m. that Thursday, we'll be having a 529 plan. Myself and Jeff Akers will be doing a college savings plan talk on how to invest in the Maryland plan and also into a national plan called College America. We'll be going over those plans and why it's a good thing to do for your kids and for your grandkids. So 529 plan will be our talk on May 27th. And then we're also having our radio show that Saturday morning at 11 a.m. on 529 day. We're going to have our college savings talk on that day. Let me see if there's any other things to cover. All right. We thank you very much for watching today, and we look forward to getting to see you soon. Thank you very much, and be sure to contact us with any questions.